Thanks everybody for joining. So we've got Paul Deane here today for, I think this is our 5th, maybe our 6th RiskWi's Reading Club event. And I think this one's particularly exciting because we've got somebody that's willing to talk not just on the theoretical of it all, but of the some of the applied as well. Reading the abstract that came through from Paul, I think there's a lot of teasers in there and a lot of stuff where you say, gee, I hope I can learn a little bit more about that as he speaks as well. So really looking forward to hearing from you, Paul, and over to you.
Thanks, Brendan. Yeah, look, I probably was, well, hopefully it was a bit of a teaser, but I probably, being a reading club, I probably was a bit light on what I sent around. So I thought I'd actually start with, I guess, a bit of a thought-provoking question when we talk about, or the way I think about risk and what I've been focusing on over the last couple of years. And I'd say to you, do we think Warren Buffett is lucky? And when I talk about, I'm not talking about his age. I'm talking about whether he's been, lucky as a portfolio manager. Now, I'm not going to ask for any raise of hands or anyone to, and maybe if we think it's a simple question. But I suspect most of us, and if you think about his track record, he's had an incredible track record from an investment side. I haven't looked at it more recently, last decade or so, but for a 20 or 30 year period, he was probably doing plus 20%, return on assets, compounding sort of thing. So I suspect most of us would say, no, he hasn't been lucky, that he's probably been this idea of a decent portfolio, what I'd call a decent portfolio manager. And that word portfolio is really sort of the key to, I guess, my thrust of research and also just what I'll touch on a bit today. But, we can think of portfolio, I guess, conceptually as in finance, it's just a bunch of cash flows or assets. And it's the question, one of the fundamental questions as a manager is how we allocate that portfolio, which can have a large influence on wealth. I guess from a farmer, if we use Buffett, obviously he's got a fairly wide universe of assets or cash flows, businesses that you can think about. We probably tend to think from a farming perspective that it's probably a bit narrow. It depends on the goals and all those sort of things, which obviously. Yeah, I guess all I'd say there, though, is, well, increasingly with, finance and technology and markets, it is a lot more easy for obviously everyone to access a wider universe when it comes to allocating or diversifying off farm. And the other aspect of portfolio is the idea around portfolio theory, which Markowitz seminal paper back in the 50s, where I guess it was really about two key things. One, he really brought risk to the prominence as far as in the decision making with a portfolio, that it wasn't just about returns, risk. So in a way, I still think, we're only 70 years where we actually have started to consider risk in this broader scheme of things. But the second part was the idea that when we combine that that portfolio, we can end up with lower risk depending on what the variance and the correlation between those assets or cash flow is. And that's where the idea of obviously diversification and probably one of the few economic free lunches idea comes from. Now to jump it back to Buffett and the question initially, and we see this in farming as well, and it's an ongoing debate. But of course, Buffett achieved that performance. When you think about it, his philosophy is to know a couple of businesses very well, and so his whole strategy has actually been, quite a concentrated portfolio. And so there's, again, there's, I guess, similarities in way we can think about that from a risk management perspective or asset allocation from a farming side as well. But those two, that idea of portfolio and how we think about risk was the focus of my PhD, and we did do it on the Australian grains industry and from a producer level. So, and I just want to thank Rick and Brendan for the invite before I get too far into anything. So look, I'll try and be brief, and look, if you want to ask questions as we go, if you can jump in. I may miss you if you're on the chat or whatever, but Brendan, or if you want to jump in at any point if the questions comes up. But look, today, obviously not going to go into too much detail, but it's, I guess, a bit of a sample of some of the things that and methods that we used. And a large part of the focus of the research was thinking about price and yield risk from a historical perspective or past risks. Now, the other thing I just wanted to say with this, I'm not into econometrics, so it's not about that side of things. But we took a deliberate, what I'd call exploratory sort of statistical approach, where we're trying to look at them, feel what the data's doing, rather than trying to spend a whole heap of time trying to quantify it exactly from a statistical perspective. There's some examples there of some of the questions that we might be able to flesh out with some of the research. But I just thought just wanted to cover really, and apologise if we're going over some old ground here, but again, I guess framing the context of the research and how I think about risk there. There's a few important distinctions when we talk about we think about risk. We tend to, it's a broad category, but involves risk and uncertainty, and they're used interchangeably, and we accept that. But from a decision perspective, and how we think about researching risk and also making decisions there and managing risk, they're pretty important distinctions. So, risk is the idea that we know the risk is there, whether it's yield risk, and we think we can put some pretty decent odds around what the probabilities and outcomes would be. And so the idea that we'd call that we're fairly competent around risk. Uncertainty at the other extreme is, Donald Rumsfeld's famous unknown quote. There's black swan, all those sort of ideas, but at the extreme, it's the idea that something's beyond the realm of our human experience, or we can't imagine it, so we can't quantify it, and that has implications on how we think about, or we can't model it, basically. And again, this spectrum, I think of this as sort of a continuum. There's no hard and fast on some of this, but I often do this with students. But if you look at Trump, for example, sticking with US story, but where would you put Trump's within that realm of between those two, and the impact he might have on administration? So everyone's out there prophesizing about what he's going to do and what might happen, which again, to me, it's fairly ludicrous in a way. I mean, he doesn't know what he's going to tweet in the next 2 hours, let alone what might happen in the next two years. So again, even though we say it's a risk, it's a lot. I think a lot of these things we talk about longer term sit much closer to uncertainty than what we probably imagine. The other one, difference between tactical and strategic, and again, assuming RiskWi and N and all those things, is been fairly well focusing on the tactical side. Again, this piece was really more around strategic, longer term thinking. Within that obviously fits enterprise mix and that question. The other point I'd make here is about, whether it's the financial or economic outcomes, but you can think of this in terms of the difference in bet size as well with some of these, that tactical decisions or whatever mightn't require a lot of extra investment, whether it's operating or capex, whereas once we get into the strategic realm, often we're talking about much larger bets that are unique in a way, and we don't always get a lot of repeatability in being able to make those decisions as well. So again, once we move further up to that strategic area, again, if I use Buffett, but looking back, how much of, say, the past decade or so, with perhaps, if you could argue, cropping's outperformed, for example, sheep, how much has that been to luck, or just those particular, run of years being, I guess, a unique set of circumstances? And, certainly in finance, when we talk about portfolio allocation and the 2008 commodity boom, if we go back to then, who can remember that? But you know, we had hedge funds coming through and they were all the rage, and, you know, up until 2008, you know, the hedge funds that are investing in commodities killed it. You know, they were a bit of the sort of right strategy at the right time. So there's some of that comes into when we shift between tactical and strategic. And of course, once we get into further out, you know, we run into this issue of uncertainty and we can't even quantify it. So I don't know whether Bill's online or not, but, you know, you've probably heard Bill quote, "We simply do not know." And that's as we're moving further out into that strategic realm, which is what makes decision making or analysing decisions all that bit harder. And look, just wanted to make the distinction as well between objective and subjective probabilities. You know, and there's nothing wrong with using past data and those sort of things, but I think we just need to, you know, especially in terms of research and visibility and being honest on that distinction between objective and subjective. And, you know, over this part of this research, you know, it's sort of obvious in a way, but even looking back, you know, whether it's climate data relating to production risk or prices, you know, there's still a degree of subjectivity in the period we select between with looking back at the, you know, the period of the data we're looking at. How far back do we go in climate? You know, to actually capture whether it's intra-year or even multi-decadal type variability, if you believe in that sort of thing to do with climate. So, you know, I think the challenge, or just to make sure we're explicit in our assumptions between that distinction between objective and subjective. And the other point with subjective is that, and, you know, we don't always see it, but I think critical, it emphasises the need that we should always have sensitivity analysis in our analysis and how we think about it. So time's a common one to all three of those. I'm not going to spend any more on that. Getting to actually some of the examples of the research that we had, and as I said, a large part of it was about, as a starting point, trying to describe price and production risk. But really the two angles I came at it from were the idea around probabilities, distributions, theories, just as I said, describing it in those terms, not necessarily in full statistical terms. But the other one, taking the idea from portfolio theory, was that correlation being a key input in trying to capture and describe risks across the business. So if we look at price risk, this is just some examples. So we had commodity prices, I think, for 5 different grades of wheat, two malt, canola, and 4 pulses. Weekly data adjusted back to, in real terms, back to sort of 2009. And these are track prices, so you can work back to farm gate. And again, some of these numbers you may have seen some analysis on, but it was about trying to initially get a feel for, you know, the differences and similarities between some of these. So you can see the average differences between some of those commodities. We did this across 5 port zones as well. And the reason, you'll see, we can do tables all different ways and stuff for all different port zones, but, you know, it was quite a systematic approach to trying to get a large data set across Australia, consistent, because really part of this research was the idea that, you know, we could use these inputs, or certainly as starting points, to feed into case studies or whatever, or whether it's, you know, decision tools, perhaps, you know, RiskWi or whatever. So that was my thinking, that it was quite broad as far as trying to bring together some consistent data sets. CV, coefficient of variation. So that's just was that question around inflation? Okay, it's popped up. I didn't quite see the full. Yeah, but sorry, these are real prices. So yeah, they have been adjusted back for inflation over time. So In
sort of,
$2003,
fairly-
basically what we're saying is the mean price over the last 13 odd years has been about $350 for APW track in Geelong. So coefficient of variation, there's not a lot of difference there. And again, it's a crude measure of volatility. It probably depends on some statistical assumptions on whether it's valid or not. But you can see there those three commodities are fairly similar. I mean, intuitively, as we know, lentils are deemed fairly volatile, and that shows up around CV there. You can see, so to the left-hand side, that's what the distributions look like, sort of plotted probability distributions. And you can see the skew there, which is a positive 1.6, and that's reflected, you can see visually in that distribution. They've got a much longer right-hand side tail than wheat or the grain side of things. We can start on a percentile basis, and again, these are just inputs how we think about, because you'll come to see when we're modelling your farm level, these presenting these probability distributions in terms of percentiles helps us with thinking about our inputs into models. But for example, canola, so P10, that's the 10th percentile and 90th. So basically it's saying, within 80% of the time, the canola price has been within a range of about $220 Aussie in real terms. Can we cut the same analysis across all the different port zones? Some similar patterns here, reasonably lower volatility for grains. In WA, what's, interestingly, well, perhaps not if you understand this, but, the distinction, I guess, between, some of the pulses became quite apparent from a risk perspective, price risk perspective in this research. We're seeing in terms of CV there that the volatility for lupins is actually not that much different to grains. The skew there on canola is a bit stronger, and the driving that is that sort of $1,200 high. So it'd be, they're the sort of things that when we talk about exploratory analysis and then trying to use that as inputs as to future probability distributions, trying to flesh out some of the reasons or differences perhaps between some of these regions is useful. So that's the first part of the equation. So that's capturing the variance or volatility or those risk characteristics. And then the second one is this idea around the importance of correlation between different risks. And so we have, this is, so for Port Adelaide, so APW versus differences there. And the lentils obviously stand out there as having basically no correlation. We still get benefits in diversification basically as soon as we move away from one, and these are linear correlations. And you can see canola, malt barley and canola are fairly similar, but the standout there is the difference in correlation with lentils to the other pulses. And the other one that very similar, and I haven't got it here, but if we go up north, chickpeas had, basically zero correlation to grain prices in that zone. We can start to cut the data in terms of comparing across geographies or port zones. Again, these are averages, so but there's some sort of rules of thumb that seem reasonably consistent. There's a $8 per tonne difference there between Port Adelaide and Geelong, and we've got different grades there. Again, those are averages. So I don't know, Ross King will certainly done some work on, depending on the state of the market, what those, the levels of those premiums and discounts between grades look like. But probably the more interesting one and question around, and I think when Rick and I briefly talked about what I could include, but again, whether you think we're thinking about, or for risk-wise or whatever, but if you could agree on theoretically one price, whether it was based out of Newcastle, could we use that same price distribution for or price risk characteristics for all the different port zones. And so this is looking at the correlation between Newcastle and the different zones there. And you can see East Coast, as we'd expect, you know, they're fairly close. But WA, as we move further around and become more export orientated, we start to see that relationship or similarity in price movement start to break down. So, you know, we could certainly say that there's, well, firstly from a farm perspective, there might be some price diversification benefits, probably reasonably small between an East Coast and WA farm, but it also shows that the distinction in the market, whether it's export orientated or more domestic market influences, has a different some different risk characteristics associated with how we'd think about correlations between regions and markets. Canola's looks a bit easier in terms of that. So there's some examples from some of the price results or price risk analysis and characteristics. The other one we looked at, yield risk. And as you probably all appreciate, trying to find consistent data sets across Australia over time is pretty hard. Well, unless I certainly don't know of any, and certainly going back over time enough to try and capture some of the climate variability. So my solution to that was to take and model about 40 sites based on, I think, well, James is online. James, how are you? I think it was your summer fellow paper, was it, back in, where, you know, James had documented the inputs for 40 odd sites across Australia. And so we used that as a basis and ran some fairly long-term climate data back through them. So that, you know, you could argue there's some climate change influences in here which I didn't account for. Part of it, just as background, part of the reason I wanted to go back so far was actually to do some time series analysis on some of that data, you know, pulling out trends, but also whether there's shorter or medium term, you know, serial correlation between some of these inputs as well, including price. But so I think one of the, and again, if I think about it from a portfolio perspective, what I was interested in was starting to think about, well, what would you know, the correlation coefficients look like for production risk between different regions across Australia. So this is basically using those APSIM, that APSIM data across those sites, and we're looking at the correlation coefficient on the vertical, and then basically the distance between sites. This is for wheat. So you can see there, I mean, in a broad sense, we get, you know, a whole fairly wide scattering, but not much falls below sort of a correlation of 0. So even at 0, there'd be still significant benefits to diversification. And again, I'm not certainly advocating that that's the only decision here when we're talking about geographic diversification. But if we are trying to model it, some of this sort of input is important. But the other thing I'll just say here as well, bear in mind, these are paddock level. So we could, again, if we go up one level to a farm scale, we'd expect some probably changes in some of these correlation coefficients. But we can, you know, break it down. I broke it down by different states. So you can see there, even within WA, we can get some, or within state, we can get some diversification. One of the interesting things that came out with those is there's a couple of sites, and again, this paddock level, where these sites consistently showed sort of a much lower correlation coefficient across pretty much any other relative to other sites around Australia. And so Maitland, and again, some of you will know certainly these areas better than I do, and again, this is intuitive in a way. We're talking about sort of lower latitude, perhaps higher rainfall, different climate environments. But Maitland in South Australia, Borden in WA, and then Inverleigh in Victoria. Now, those three sites all generally had much lower correlations to the rest of the sites. And what's interesting when you actually then go and look at those distributions, they actually had a negative skew, a fairly strong negative skew. So, we had a lot of yields bunched up, I guess, higher at higher yields, and then the skew was actually to the left-hand side rather than a lot of other distributions that came out of that were, you'd argue, had a skew of 0 or slightly positive skew to them. So the last part of the research was then to try and use some of those inputs, but also see if we could, from a portfolio perspective, one of the certainly at a strategic level, one of the issues with trying to evaluate risk in decision making is, looking at risk in isolation. And so we pulled together this model trying to capture as many of the risks we could. So price and production risk, interrelationships between those risks, and I'll maybe mention yield and price risk a bit in a minute. But from a farmman economic perspective, we categorise the three main risks being business risk, being price and production, and then the third one being financial risk. So this model, and there's some rules around, and I won't go into details now, but we actually incorporated financial risk into this model, which makes it a little bit unique, as well as having the ability to sort of test some ideas around, or perhaps it's a new technology or whatever that might actually alter the risk profile of crop risk. And so what I mean by that is, just to give you a feel for really what we're talking about within that model. And when I say it's a model, it's in Excel. We use that risk. So it's stochastic simulation type approach where we have probability distributions defining risks as inputs, and then we get outputs to do with what we're measuring, which in this case was terminal equity over time. But the blue here, so this is based on a case study type approach in the Mallee. But the blue there was the starting crop yield distribution, just to give you an idea. And again, I'm not saying that's right or wrong, but it was we'd call that a non-parametric distribution, as an aside. And one of the things I've mentioned, but, we did try and look at, from a both price and yield perspective, what univariate distribution would best characterise some of these risks. But with software and that now, we can actually move beyond that. We don't necessarily have to be constrained to sort of a single type of shape or distribution. We can be fairly creative. But so this distribution, you see, it's got sort of, a fair proportion of low yield, but also high yield years. So frequency being on the vertical, and then tonnes per hectare on the bottom. So that's our starting distribution for crop risk. And then in this example, we put a climate overlay across it and what that might do to the distribution over time, and that becomes our ending distribution at year 20. And then basically we segment that back or change it slowly over time as the underlying structural change in risk, in this example associated with climate change. So that climate scenario, was a 1 degree warming, I think less 5% rainfall type situation, which is based on Victorian government regional type modelling, which I noticed they've just come out with something new in the last week or so. And then climate scenario 2, just the same idea, the starting distribution's the blue one. And in that instance, we used the analogue type approach, and that was Boolean climate, and that's what the distribution looked like. You know, post running it through AppSim. But the idea being that this model's set up that we can, you know, we can, for whatever reason, whether it's climate or technology change, we can structurally adjust that idea around risks over time as inputs. So we end up with a model, and it's, you know, it's exploring, I guess, the idea around one portfolio strategic type risks. You know, we're using it to think of it. I mean, one of my questions was, well, how important is climate change relative to all the other medium-term risks that you know, farmers might face, or what we might end up with, and also things like questions around, again, there's been a whole body of literature on risk research, you know, debating the shape of what, you know, yield risk should look like, or price risk, all those sort of things. So part of my thinking here was, you know, testing things like, well, or sensitivity, or how important are some of these assumptions in outcomes on a risk adjusted basis. So just as an example here, rather than go through a whole heap of results and details, but if we think about compared to the baseline, and there's, you know, there's a incredible raft of assumptions going into that, and some of you would agree or disagree with how I've done that, and that's fine. I'm not saying this is not about trying to, you know, give outcomes or answers as to actually what's the best thing to do. It's really more of an understanding on, I guess, what we might or should be focusing on from a risk perspective strategically. But so what I'm saying here is, for example, in terms of sensitivity to the baseline on a risk adjusted result, having a starting distribution shaped like that versus, if you go back what I was saying here versus this blue one here, so pretty, as about as contrasting type starting risk distributions as you can get, is in terms of sensitivity to the model outcome, being equity and on a risk adjusted basis, is actually about the same as what we would get based on our climate change one scenario. So again, they're two extremes. If we're debating whether a distribution should be, you know, Weeble versus you know, a normal distribution or something like that, the gradient's going to be much smaller. So for some of these strategic questions, maybe, for example, the question around starting distribution or risk characteristics may not matter that much. But the other thing that is always, I think, probably intrigued me is this idea around the importance of correlation between our crop prices and yield assumptions. And often it gets left out, which implies that, you know, the correlation is zero. But as an example, again, if our correlation in this modelling, if the correlation coefficient between price and yield moves by 0.2, so say it goes from 0 to plus 0.2 correlation coefficient, so, you know, fairly small, that's again the equivalent of actually changes in risk and outcomes associated with climate change. So we can start to use this model that, you know, while we focus, for example, on climate change, you know, there's this whole raft of risks that we actually need to think about when we get into the dimensionality of trying to evaluate risk more strategically. I've taken up too much time, but just a few closing comments. Look, on the objective-subjective debate or idea, and look, I think it's normal that we use historical data. I think it's our frame, so I'm not criticising that per se, but there is that subjective element even on how far back we go and the relevance. And I think once we start to get further out into the realm, you know, I just make the comment, we're probably not very good at reimagining the future. We are, to an extent, framed to the more recent past. You know, the portfolio thinking, it can certainly be used from a tactical perspective or decision making. Whether we're thinking about from a rotational gross margin perspective, bringing in those correlations and variance assumptions and how that might impact some of the results would be, and again, I don't know what you're already doing in that area, but I think it's important. And, for example, coming back to the price yield relationship or assumption, that was found to be pretty important, and I think that emphasises the fundamental that we think of risk as being downside, but what it does show is the importance of capitalising on the good years as much as trying to manage the bad years. And the last one is the communication of risk. So Bergman, who's pretty influential environmental decision maker and done a lot of work in risk assessment, is fairly critical of disciplines as far as how they communicate risk. And I think it's, there's some validity to that argument on basically acknowledging what's not in models, what's left out, and what we don't know in terms of, again, certainly moving out further in time, we start to bring in a lot more uncertainty, which by definition becomes pretty hard to capture in how we model things. And I guess related to that, I think the challenge with that sort of research is while we might be thinking about enterprise diversification or whether it's off-farm diversification, trying to actually show, because of that uncertainty, trying to show the value in diversification, I think is challenging by definition as well. So that's, I guess, a quick run through of some of my thoughts, and apologies if I've gone over some old ground, but
that was good. Thanks, Paul. So yeah, as planned with all of these, we've had Paul speak for about half the time. We've got another 20 or so minutes for questions, discussions, and reflections on what this might mean for RiskWi's as well. Hopefully, with questions that help extract more knowledge from Paul as we work through it. So if we can use the raise hands function, that'll help me if you have a question, comment, query, suggestion. If you can use that. If anybody wanted to go first. This is where I don't have a Dorothy Dix or a pre-planned one, but yes, Lindsay, please.
Well, I thought I'd kick it off. Paul, you talked about the potential importance of correlation between yield and price in terms of them not being completely independent. Do you have any recommendation on how we might manage that codependence or integration in some future analysis if we were to do that going forward in the future? Because most people keep them as independent variables when they've analysed that sort of aspect. So any thoughts about how you might go about that in a more effective way?
Yeah, good question, Lindsay. I mean, look, there's been some OECD work. I mean, I've done some analysis with this work as well. I mean, statistically, it looks like, we intuitively, it makes sense between supply and demand. We tend to think that, there's a negative correlation to some extent, whether how minor or how significant it is. And so I think, we're probably erring on the side of when supply is low or whatever, prices tend to be higher. There is that dynamic a little bit at play, although, again, it gets into the subjective nature. And part of the problem with this is we only have 12 or 13 years of really, data post deregulation on the price side. So it's not, I think one of the things that is we can decompose prices based on, global price and basis and those sort of things. I think there's more work there that fleshing out the story on what's going on with correlation between global prices and basis. And the reason I say that is because intuitively to me, and also I think some of it when you look at, basic chart, but what's the last 10, 15 years to me, I think is, well, whether it's unique or not, but what's characterised it is that we've tended, and again, there's a bit of luck here, particularly with the Ukraine-Russian war. Not luck, but as in they're not necessarily causality, but we've tended to see high global prices associated with high, with our La Nina, multi-year La Nina type years. All right. Now, in saying that, there is we think of La Nina good for us, but across the Pacific Rim, it's been shown that it tends to actually probably be negative on a basis for global production or agricultural commodities and production. And even World Bank and those have shown that La Nina type years tend to be inflationary for world food prices and things. So it's a really interesting dynamic. I think the question is whether how much even using the last 15 years is that a one-off, or is it so it's that classic, it's a tough question from a subjective perspective. I wouldn't, well, I think there's nothing we can necessarily do to control it. We're not saying that, but it would be interesting to see how it might change some of the payoffs and things to do with some of those tactical decisions, whether the assumption is that there's no correlation, or whether it's minus 0.2 or plus 0.2 or something like that. So, and look, all I can say there is that, as a starting point, again, bringing some sensitivities around those variables, whether, but that it is, I think, a pretty key one to be thinking about, not just ignoring it and assuming it's zero.
Feel free, if your number is number one and the next question's finished, feel free to go ahead. Peter, you got number one at the moment.
Okay, thank you. That correlation stuff's really interesting. I think someone a long time ago looked at SOI and the US dollar, and there was a correlation or something there explaining that, but which would affect things. But my question is really about your really interesting, well, to me, challenging yield, probably distributions of yield. I guess just to have such a strange looking distribution when, if we say yield is largely driven by rainfall, seasonal rainfall has such strong central tendency, I would have thought. Mm-hmm. Well, yeah. So does the question make sense? I mean, what's happening there in those APSIM simulations to give you those sort of two peaks and a valley in between in terms of your yield distribution, if I've understood that properly?
Yeah, no, it's good. Well, one, I could have gotten APSIM wrong. No, but so Peter, that was based on a case study type approach in the Mallee. And so that's based on this, I guess the soil and climate characteristics there. I guess as a starting point, I don't know whether that is right or wrong. And of course, the other aspect with that distribution in itself is a function of N assumptions and those sort of things, and what we put on. So, I wouldn't necessarily. Well, I can show you a whole raft of, again using APSIM. There's a whole range of different shape distributions. Like that's just one that came out in that particular circumstance, and also that's at a paddock level. But if I think about the Mallee intuitively, it's is it right or wrong? I think there's a degree of that they have a reasonable number of bad years or failures, and then there's some really big good years, and whether it's hollowed out like that in the centre or not is reality or not, I don't know. But I can show you a lot of other distributions that we used in APSIM that were totally different to that, and they were probably more consistent with what you're thinking. So, I'm not saying that's the distribution, certainly for anyone. It was just sort of, and it was convenient in a way because it was such a contrasting distribution to being able to then test it against more of a normal shape central distribution. So, I'm not saying that is the distribution for that case study, but it's again, that's, I guess that's where you guys come in. We did, we did have some input from a producer level. But yeah, I mean, that's, I guess, subjective. And you know, and again, there's, as we know, AppSim doesn't necessarily capture every degree of risk or change there. So yeah, I don't know. James, have you?
Yeah, I'll defend you more vociferously than you're defending yourself, Paul. It's like that's like I think that's the Mally. Like it's consistent with the same sort of shape yield profit curve that you would get for that environment for Bircham. So you get more of a straight diagonal line. So like I'd consider it like, I guess it is a little bit bimodal, but it's pretty flat. Whereas Maitland, you get a real it's not S-shaped, it's got a negative skew, as Paul says, and then it comes down in a straight line. It's a very reliable environment. Yeah, it's like obviously yield profits AppSim too. So but I don't think there's a artifact of AppSim in there. I think if you looked at rainfall in those contrasting environments, I think you get something similar.
You can get flat, but not a dip, I guess, is the.
Yeah, I guess. Well, yeah, it is. If you look at the blue lines, which is the non-climate change modified one, like that was pretty flat rather than dippy.
Yeah,
wasn't it?
and Peter, I guess, yeah, look, bear in mind, so I think that's each one of those is actually a year. I mean, I think we only took like the last 30 years of data as well. Again, there's subjective nature there. You know, how representative of that we don't know. But yeah, I guess, look, again, because as soon as we start to shorten the sample, yeah, what the distribution, you know, looks like. If you've ever, you know, run at risk or whatever, you know, the idea of convergence in simulation modelling, I guess it's a bit of the same. We can still get some, until we get convergence in the modelling and run it 10,000 times. We mightn't, you know, when you stop it at 50 samples, it can look very different to what it stops at the end. So I'm not. Yes, you're right. It could well be flat, but would have been a better test. I have no argument with that.
In the context of the last 30 years, like that makes even more sense that it is sort of bimodal like that, because think of a time where there was 220 millimeters of growing season rainfall at Birchip in the last 30 years. I can't think of one. Like it's either been too dry or too wet. Like there's, yeah, the middle has been hollowed out in the last 30 years. Anyway, there's a project for you to go look at the rainfall records.
I will, but I guess there's more interesting things to discuss here than rainfall. Hard to imagine, but there probably is.
My question was just to point out that Masood and Kate have questions in the chat. I was trying to get Brendan out of a hole because he didn't have his Dorothy Dixer. But if you want to look at those,
right? Yeah, thanks.
We've got Kate then Masood with their hands up. So Kate, if you want to go and ask your question direct to Paul.
Thank you. Yeah, I just had a question because we've had a really wet November. So we've sort of had like a decile 9 following like about 4 months of decile 2. So we've gone from not enough rain to too much rain. And some of the farmers that I've been speaking to have been saying that in the last 3 out of the last 4 years, we've had greater than 50 mil in November, which is more of a like what they call a northern climate rather than a southern climate. And they've noticed that in the rainfall records. I'm wondering what your thoughts are on, like, in terms of risk management, like, because this seems to be a trend, is that something farmers should be planning more for, that summer type northern scenario that we're probably not used to down here?
I know a little bit about climate, but probably half of you know more about it than me. Look, I think you know, when you look at the climate outlooks, climate change, I guess that's consistent with that there is, you know, they're expecting perhaps more rainfall over summer, although I would note that, you know, certainly the higher level models, there's less, well, if I use the word, they're more ambiguous around rainfall than what they are temperature. So I'm not going to say one way or the other, but look, it's probably, yeah, I think that could be a very, more of a medium term pattern that emerges, and then how the systems or whatever we do around that would be. I can't necessarily suggest what the result of that would be. But yeah, I probably can't add too much more than that.
Thank you.
I just going to, sorry, just on the inflation index question. Yeah, so those prices were real prices. Yeah, so they were factored on a weekly basis, and that was done simply by factoring from an annual inflation number back to a weekly factor.
Yeah, Paul. So on this inflation index, where there's so many different indices, what do you think? Which one is appropriate? Is just the CPI or some other measures of the index? Which one is relevant in this context? Yeah.
Yeah, it's always a bit of a debate. Look, we just use the just the broad annual CPI. I mean, obviously you've got the RBA and use trim mean and all those sort of things, but I think from the perspective of what we're doing, I don't think it makes much difference. So you can use, yeah, but just a broad inflation measure would be the way to go.
Do you think that there's a lot of, differences in the nominal versus the real price distribution, or they look the same?
Sorry, I just struggled to hear that. Can you say that again?
So in terms of the shape of the distribution, if you look
Yep.
at from the nominal price distribution, is it looking the same as real, or there are a lot of differences between these two?
Oh, I didn't even look at nominal. But yeah, you would expect that they would be different. Yeah, just because of the trend over time to do with prices. Yeah, certainly. Just as soon as you get after a year or two, it's real prices that we think about.
Thanks.
So again, that should be, even that work there, that was to June 2023. We're already about 18 months in. So again, just, they're based on 2023 in 2023 terms. So again, you could update those to 25.
Yeah. Thanks, Paul.
Bill, you had a question?
Yeah. Paul, when we started, remember we were thinking about tactical versus strategic decisions, and sort of, I think my idea might have been that, well, the within-year tactical stuff, the farmers will be all over that, and it's having a closer look at strategic decisions and getting them right are going to be the key to building wealth and succession and all that sort of stuff. Where did you end up on that tactical versus strategic decisions as an emphasis for, say, R&D work?
Well, I guess we set up the model. So, I mean, one of the things that interested me was, and again, from an R&D perspective or even crop breeding, sort of medium term is, how it could be technology or anything, whatever you want to call it, how that might change the shape of the distribution over time. In the US, there's some, for example, work done on corn crops and things where, because of the changing in genetics, that they're saying the variance is increasing over time, that there's almost these two sub distributions, and so I think that sort of idea or test and how, from an R&D perspective, what you focus on and how it changes strategic returns. Productivity growth is in there as well. So there's all those type of things that can be used strategically. I guess the other thing we never sort of got to in this research, and again, some of the inputs were there, but the question around geographic diversification is still, and again, it's not you know, I know it's a very, there's a lot of parts to it, but you know, certainly the yield correlations and even the price correlation to some extent on wheat. There's, you know, the east-west or an east-west model of, you know, splitting farms or whatever. I think is probably something that could be explored further, and the reason, and as well, that fits because the dimensionality of once we start to think about, well, what do farmers do to diversify, and on the assumption that they want to stay farming and they want to stay in grain, maybe they don't want an interstate farm, of course, and I can understand that, but you know, there may be some, I think, exploring. You know, if we had another case study in WA, for example, we could combine the two and see sort of what that does from a risk return perspective. Would be interesting.
The hands have sequenced our questions pretty well, Bill. Going back to your lentil correlation, I mean, it's amazing, isn't it? So almost 0% correlation, I think, with the other crops.
Mm-hmm.
And one of the strategic issues that groups like Eyre Peninsula are looking at is shifting out of sheep towards, I think, essentially more lentils. Do you think that lack of correlation is adding to the appeal of that shift from a portfolio basis?
Well, I guess the trade-off there, Rick, is that the variation, the volatility is, even though the correlation, there's a benefit, much bigger benefit from correlation. You know, there's a much greater variance or volatility associated with that. And you know, if you looked at that distribution, you know, it's a threefold change from the low to the high in lentils. So it's certainly, and we know that's intuitively risky. I guess I can sort of, you know, again, there's a whole range of, you know, decisions that come into that. Profit outlook and cost to grow those crops as well is another one. But maybe I'll just sort of answer that indirectly by saying what was interesting when you compare it to faba beans is that faba beans had a correlation coefficient that really wasn't much different to canola. So it's somewhere roughly around 0.6. But it actually had a higher, you know, we use coefficient of variation as a proxy for volatility. It actually had a slightly higher volatility than lentils. So what I can say is that certainly there's a vast difference from a price risk perspective between faba beans and also lentils. Now, you know, there's the profit dynamic and outlook there, which is probably going to dominate the decision, and agronomic and all those things, rather than necessarily thinking about the correlation of those commodities. But as I said, the chickpeas came through similarly as well, to similar characteristics to lentils.
All right, a very quick one, Paul, as we approach that exactly 3 p.m. If you had 30 seconds to summarise all of that you've presented, but you had to orient it towards growers about what they should be thinking about in their risk management, have you got a 30-second spiel or summary that you'd give to growers?
Keep focusing on the tactical, which you're already probably doing pretty well. Watch out for this idea around uncertainty. You know, even with climate change and those sort of things, and you know, we focus on climate change, for example, and production risks and changes there, but you know, the outlooks to do with markets and what prices are going to do over the next 10 or 20 years is pretty diabolical, with, you know, changes to policy around whether it's, you know, renewable diesel, all those sort of things, or aviation fuel. So, you know, and Trump and all those things, maybe we always say that, you know, it always feels more uncertain than what the past has. But yeah, I mean, it may well still be prudent that getting something off farm still makes sense, even if we can't show it from a diversification or benefit necessarily in modelling in those sort of things. But then again, even that in itself there's still that trade-off in you need to be able to reinvest in the business enough to make sure that you're maintaining that productivity at 1.5% or 2% every year to keep the business sustainable. So, it's not clear cut. I think larger businesses, you know, when I say that, you know, 20 or 30 million in assets, it's probably easy to park stuff or start to think about off-farm diversification. You know, smaller farms where they're battling to try and keep up, you know, it probably might be the case of specialising and reinvesting. So, yeah, that's my I can't give financial advice though, but that's
disclaimer noted.
Don't take that as anyone as financial advice.
Thanks very much, Paul. That was really good. We had about, I think, 26, 27 at peak there, and lots to take away and think about as well. So really appreciate your time. Thanks everybody for joining. Paul's details, I'm sure, are online if you want to grab them. And we look forward to any suggestions for future speakers as we continue this series. Thanks, everybody. Thanks, Paul.
Thanks all. All right. Thank you.